Welcome back to another episode of Fund Friday with Brett Swarts. He's a very interesting guy here. We're going to talk about all things capital gains related, how you can avoid, hopefully, or defer paying taxes, I should say. I don't want to get a letter from the IRS here. But Brett, thank you so much for coming on the show. We just did a fun show, an episode together on your channel.
Craig, it's great to be here. Thanks for having me. Yeah, I enjoyed our time together interviewing you. Make sure everyone checks out that episode. We'll plug it at the end.
Yeah, without a doubt. So you have a very interesting approach and angle here, which is exciting for me. So if you're a listener, this is not another capital raiser. This is a capital unlocker. I'm going to get in a little tongue-in-cheek with that because his view of the world is a little bit different. And I think if you're a high net worth person, if you're maybe someone who's closer to my age and your dad might be selling a business or has got a lot of cash they need to unlock, if you will, you want to get creative about how you can really multiply and compound your wealth. This might be something that is really useful. So if you know anyone who might need to listen to this, please send this along to them because this could actually really change their family's life and their financial future. But without further ado, Brett, how did you get to in the chair you're in today? What's kind of your origin story?
Yeah, so I'm originally from the Bay Area, much like Mission, San Jose, Fremont. Fell in love with real estate at a young age, the sticks and bricks, by building it with my parents. In fact, we'd build houses all over the Bay Area: Palo Alto, Menlo Park, Atherton, Fremont, Mission, San Jose, Newark, Pleasanton. In fact, MC Hammer, I remember my dad, we would drive by his house that was like, it's really his castle or his more than an estate. It was this gigantic, mansion. And then we didn't build that house, but we built the houses on the hills below, right? In fact, one of the houses we built was like 2 doors down that MC had bought for his brother or somebody. Part of why he went broke is because he bought so many things. But anyways, long story short, we built houses. This is what we did. And this is in the kind of the glory days. 83, I was born. I'm 41. So, fell in love with the 49ers at a young age and going to A's games and the lumberyard with my dad, learning how to work hard. And my brother was the first to graduate college and I was the second. So my mom and dad's vision was for us to not just work hard with our muscles, right, but to work hard with our minds. And so that's where I started to study and practice multifamily brokerage with a company called Marcus and Millichap. That was in 2006 before the crash. Played a little college basketball too, which was a lot of fun. That paid for school and it's, a small private school. But I love hoops. But it wasn't until 2008 that things really changed because you kind of got serious about whether or not you're going to take this thing for real, right? Like, are you really going to stay through it when people are making like zero? Goose eggs, they're used to making $500,000 or $1 million or $2 million in commissions. Now they're making nothing. And I was the new guy who was still living with his mom, I graduated college, but I was like, I want to make this real estate thing work. So I was just, I was able to keep my expenses really, really low. But I loved real estate. I didn't really, it didn't really bother me that I wasn't necessarily making the money because I knew I was making gains in my knowledge and my expertise. And also, fast forward, get married a couple of years into that. But then, babies are on the way and then it gets really serious when the babies are on the way. And so I did what every real estate, entrepreneur wannabe does. You get a side hustle. So my side hustle was Cheesecake Factory. So by days, I would cold call and negotiate with banks to help my clients hold on to their multifamily properties in Sacramento. And by nights, I'd sell cheesecake to keep the lights on for my daughter and my wife at home. So my wife was a
retired
full-time
Uber
mom.
driver. I am a retired Uber driver, so I can appreciate that.
Yeah, you got to start somewhere. And I share that because, you might be listening to this thinking that, Craig and I just turned on the podcast and we were, had this kind of freedom and this financial success, but it's not. It was blood, sweat, and tears. 2 years at Cheesecake Factory, by the way. Living with my brother in a small condo, my wife being a rock star to be cool with that, if you will, right? Adaptable and flexible with that. But it helped us to clarify what was meaningful for us. But also on the other side, my clients, they were going through financial disaster, right? They were losing half or all of their wealth due to a lot of them being overextended, right, with debt, didn't have enough liquidity, feeling trapped by capital gains tax, had overpaid for the properties using a 1031 exchange in the prior years. And I sat at Marcus and Millichap thinking there's got to be a better way than just this 1031 exchange that all of this real estate agencies we talk about every single day. to bury people in these deals that were overpriced, that didn't necessarily make sense when they bought it, but they bought it because the tax man was chasing them, right? And they wanted to defer the capture of the tax man. So we learned about a cool strategy, which we're talking about here in a second, but that really helped me to learn and clarify the mistakes that people make when they make these big exits, whether it be real estate, Bitcoin, or businesses, and then the new mindsets to think through this, and then the methods to unlock what we call truly passive income.
Yeah. Well, let's get right into it then. And you said so much, it's great. And I guess before we get right into it, I'm a liar. Starting somewhere, we all have to do that. I did not kind of get to where I am today right now because, I just snapped my finger. I wasn't born with a ton of raw talent per se on the real estate side of things. This is a learnable craft and skill. And I love what you said there, the mindset of although I wasn't making money, I was earning knowledge and accruing knowledge and a skill set. And that's so crucial. I'm a big believer that you should not waste your 20s figuring this out. You should learn knowledge and start to make some money, okay, and start investing a bit because the dollars you invest in your 20s will compound and set you up for your future, so long as you don't lose it on a dumb trade or something like that. But with that said, acquiring the skill set and the knowledge and experience is so valuable, particularly in the real estate world, which is, you're competing. I'm sure you are with 70-year-olds who are really talented, who've seen every single market cycle that's really happened in modern era, if you will. So similarly, I'm competing with that as well. But this is a knowledgeable thing, and you don't just start on front. You actually start at the bottom, and it will really challenge your mental fortitude and how bad you want it. And I can tell that you really wanted it, like I did, because I was working Uber every weekend from, call it 4 p.m. to 4 a.m. Basically Friday and Saturday, then trying to work open houses, working, all the time. And that's what you have to do for 2 to 3 years to get it going. I mentioned I was doing well before I left the Bay Area. Well, I had to drive Uber and do something on the weekend before then because you couldn't even get an open house because everyone was selling their houses in one weekend and you would pick up the hot leads. So I had basically no work, but I wanted to do it. So that's a tip of the cap to you. I respect you that much more because you had to do that because you and I know what it's like to work 2 jobs. And I don't have the pressure of, when you have the kids on the way yet, anything like that, but it's tough. But with that said, let's get right into it. Capital gains. So you've got a really unique angle on this, and I want you to spare no detail and talk about your strategies and what you do for your incredible clients.
Yeah, I'll start with this concept that, and I think this is key, right? We read the book and we both love the book, Craig and I, maybe hopefully all of you too, the Rich Dad Poor Dad book, and the Purple Book. That's an amazing book. And it talks about financial freedom, right? Financial freedom, replacing all of our expenses and our living and our living expenses and our day to day, and also the things that we want to do by having some kind of passive income come in to be able to offset that. Well, I want to take that another step further, and I want to say that truly passive income is what we really want to focus on for this episode, and it's what I call either our finished financial freedom, right? Finished financial freedom, where you really have no toilets, no trash, no liability. I like to say, like Kenny Chesty, no shoes, no shirt, no problem, right? And you're sitting on the beach if you want to, and with your guitar, your glasses on, your hat, maybe your shirt on or off, you're soaking up some sun, but you truly have not a thought in the world about how clear it is that this durable, consistent cash flow is going to be coming in. And so this is the concept and the premise I want to start everyone with. That truly passive income is to your freedom and impact as compounding interest is to your money. Okay. And where the mistake that most people make is they don't have clarity when it comes to when they're going to exit this huge asset. I mean, huge gains, Bitcoin, business, real estate, primary home or investment related stock, multiple millions of dollars of gains, and they haven't clarified what kind of impact and freedom it would allow them if they could free their mind from that and have it be tax deferred in a way that unlocks this freedom and impact. And that's really the mistake that a lot of people make in the 2008 crash was they did this 1031 exchange thinking that was going to provide them more freedom and impact. They're going to change their, the 20 unit for 40 units or the 50 to 100 or 100 to 200. And if I just buy enough units, and if I just get enough of, this amount of cash flow coming in, I will be truly passive. I'll have finished financial freedom. And it wasn't the case, right? Especially in California, where the regulation continues to be more and more challenging with, rent control and then insurance costs and all of these things and regulation. And quite frankly, a lot of my clients, they have, blood, sweat, and tears for 20, 30, 40 years, and they're ready to be retired or be truly passive. And so the mistake that a lot of them make is thinking that the 1031 exchange or these old strategies are going to unlock this, and it's not. And so we introduced the understanding what that mistake is, and also understanding, like, capital gains tax is 20 to upwards of 50% of your proceeds are going to be crushed by capital gains tax and depreciation recapture. So just understanding that, right? And then understanding that certain strategies only work for certain asset types, like the 1031 only works for investment real estate, doesn't work for a primary home. We can get into some case studies now created to kind of bring this to life, but essentially this is what we do. We just build capital gains tax exit plans. We help people get truly passive income, or also to be an entrepreneur if they want to be. We do it in a way that's so flexible, and most people just have never heard of it. They don't know how to do it. The method is called a deferred sales trust, and we've become experts in this niche to build these for folks, which unlocks the truly passive income.
Yeah. So I love you said about there, which is trading a 20 unit for a 40 unit, thinking the work's over. No, actually, now you have double the amount of issues you have to worry about, double the amount of headache. And now you have takeover risk. Takeover risk is probably the biggest risk you're going to have in any property. What is takeover risk? That means when you buy new property and you're not looking at the pro forma anymore or the documents that the brokers gave you, but now this is your baby and your problem. And now you're actually going to learn how much maintenance costs, what the plumbing's actually like, what the roof is actually like, and what your tenants are actually like. Maybe they're friendly, maybe they're not, right? But that is what you have to worry about once you buy a new property. So it's not over when you do that. It's actually the work's just begun again, and you restart the process. And then guess what? Now you've got more capital gains you got to refer, and now you're more scared about a bigger tax bill and potential phantom income that comes in the future. So I'm so happy you touched the light on that, because it's not just over then. The work's just restarted.
Yeah, absolutely. So you got to build what's called an irresistible capital gains tax exit plan to really bring this thing to life. In fact, I'll bring it to life with the client named Peter. Now, Peter had 18 units. He lived in Marin, California, and he was driving 2 to 3 hours. Yeah, beautiful area. 2 to 3 hours. He's actually a real estate agent too, but he was one of the cool real estate agents because he's investing in these properties. So he had multiple properties, and he had 18 units. He had 1031 out of the Bay Area into Sacramento. It was South Sacramento, one of the roughest areas, but he got a good deal, and he had to defer the tax. But he's like, what am I doing? I got multiple millions of dollars, and I'm driving 2 to 3 hours. I'm driving, on the weekends. I'm doing all this stuff. And I mean, at one point it got so bad, there's a drive-by, his car gets shot with the car, and it gets shot. He's in the unit with the tenant, so they weren't shooting at him. But he's like, what am I doing here? I'm putting my life at risk for this thing. He's like, forget about this thing. And so I sat down with Peter, and Peter learned about the Deferred Sales Trust, and he goes, Brett, I've only ever done 1031 exchanges. Are you telling me this thing is real? It works, it's legal, all this stuff? Yes. And I said, but Peter, are you sure you want to do it? And I always do this. I'm doing kind of facetiously. Are you sure you don't want to do a 1031 exchange? Tell me why, Peter. And more so, I'm doing kind of like a case study to get some content out of it. He's like, no, Brett, I don't want to do 1031. I'm like, why not, Peter? He's like, I have 18 problems. He goes, do you think I want 36 problems? I go, no, you don't. And he goes, exactly. We're doing the Deferred Sales Trust. And so he used it. I mean, it's like, I have 18 problems, and 36 is not one that I want to have. And so we eliminated all the problems. He paid off all of his debt. He deferred all of his tax. He got liquidity. And really what we call this is the Netflix version to the old Blockbuster. Like when your parents used to have to show up, and you showed up maybe, and you had to rent that video, and it might be, you have to return it within 3 days. That's Blockbuster, right? Netflix, you can just push the button. It's there. You don't have to drive anywhere. You don't have to return it. It has an ongoing fees. Ours has ongoing fees. So, I mean, that's really what it comes down to. But people get liquidity diversification. They never go back to Blockbuster once they learn about this. Albeit the exception, if they find a deal that actually makes sense, great. We have the best 1031 exit plan that gives them that option. But ultimately, you've got to really clarify what truly passive income is for you, and what kind of impact that would unlock for you. And then look at what tool is actually going to get you there. What method's going to get you there.
Yeah, so let's go through the mechanics of what you actually set up.
Sure. Yeah. So it's a trust. So I want you to think about like a trust. So a trust is an entity that could be typically 3 different entities. There's a revocable, irrevocable, and there's a business trust. We set up a business trust. And so our company is Capital Gains Tax Solutions. We will set up the business trust with a tax attorney. And this business trust basically will buy your asset from you right before it sells it to a third-party buyer. Okay. And so I'll give another example. We talked about a deal on our podcast. It's a Menlo Park. It was an $8 million primary home sale. And this seller, all of his kids moved out. He has all of his equity in his house. He has this huge house next to Stanford University, massive gains. Did not qualify for a 1031 exchange because it's a primary, but also he didn't want to do a 1031. In fact, he was also a real estate agent. It's funny, these different real estate agents. He had sold over $100 million in Palo Alto on average every single year. He's one of those top agents at Keller Williams, like crushing it. But his own house, he's like, all my equity's stuck, Brett, and I don't want to pay massive capital gains taxes. And I have also a lot of debt too that he wanted to pay off. So we set up the trust prior to the close of escrow and prior to the buyer moving contingencies. It's important to understand that you have to set it up prior to. And essentially the seller sells it to the trust and the trust sells it to the buyer. So it's a three-party sale. The difference is the seller takes back a promissory note. So it does 100% financing with the trust, and the trust sells it to the buyer and has no gain. So the trust bought and sells for the same price, and the smoke clears, buyer has title, they're gone, and the seller is owed back from this trust installment payments. And as he gets the installment payments, he pays tax. And so that is the method that we use. Thousands and thousands and thousands of transactions over 28 years at this point. With the tax attorneys. I learned about it at Marcus & Millichap, like I said, in 2009. And there's been over about 30 no change audits, never had a change. Most of the deals have been done in California. And there's a lifetime audit defense, like all this stuff. So basically my entire day is spent with talking with real estate agents, CPAs, financial advisors on how this works and high net worth individuals and setting these things up. But at the end of the day, it's just an installment sale with the trust using IRC 453, which is a seller carryback, which most people know. They just don't know how to apply that with a trust, which is really our kind of our secret sauce.
Yeah, so let me just break this down so I have an understanding of this, so hopefully the audience does as well, so this doesn't go anyone's head, because this is super juicy and important. So let's take that house in Menlo Park, Palo Alto that was sold. They sold it at top of the market. So they basically put the property in a business trust, and then
they sold it to it in the same escrow.
So they basically sell their own property from themselves into a business trust. Mm-hmm. And then do they sell it from that point after, and then the dollars are in an account there? Like, how does that work, soup to nuts, high level, so everyone can kind of mentally start understanding how this process works and it can be applied to them?
Yeah, they sell it to a third-party trust that is not owned by them. It's unrelated to them for tax purposes, and it's kind of like a 1031 exchange accommodator. What do? You sell, and the funds go to a third-party qualified intermediary where the money sits until you move it into the next property. So ours sits in the trust. The trust is Charles Schwab is typically where we open up the account, and they're owed back the money. So they don't own the trust. If they owned it, it'd be taxable. They sold it, just like if they owned the qualified intermediary, it'd be taxable. So they sell it to the trust issues them a promissory note, and the trust sells it in the same escrow, like back-to-back sale. Like, it's just a half second to the buyer, and the buyer takes title the same way they would have, right? And the smoke clears, and what's left is the seller is now a creditor. They are the bank. They are owed the money plus a rate of return, typically somewhere around 7, 8, 9, 10%, depending on the risk tolerance of the client. Typically a 10-year note. That note can be renewed every 10 years. It can pass to kids. You can keep it going for as long as you want. Best part, of course, is that you can invest into whatever you want, whenever you want.
So basically, So you basically have that said capital in that account with Charles Schwab post-closing, and it's basically a high-earning, high-interest account at that, call it 8 to 10% roughly, in that account there, and then you basically draw from it essentially until it's basically depleted, or basically fully deployed, I should say, more likely, into various different projects, in any angle, in any facet. It doesn't have to be real estate. It could be crypto. It could be stock bonds. It could be legitimately anything, a business, a laundromat.
Yeah, 100%. That's the best part. This is why we're Netflix, right? Versus Blockbuster 1031. We can go to any asset at any time of any kind, and we can dollar cost average into investments, and they can take payment as they receive it, and they just pay tax. And so I'll give you another example. We did a $13 million exit out of San Diego. This is at the height of the market, right before interest rates shot up. And these guys do development. So they'll develop the car wash. They'll buy the land. It was an old taco stand in San Diego. And they told the taco guy, like, hey, we want to buy your land. He's like, I don't want to sell it. He's like, but you don't understand. We will JV with you. We'll put your restaurant inside of the car wash, and we'll 3x your business. He's like, sweet. I got a brand new building and it's all there, but we're going to run a car wash on the outside. So they did that. Anyways, long story short, $4 million total investment. $13.5 million exit. Well, guess what? In a 1031, they'd have to overpay and buy another property for $13 million, essentially putting all their equity at risk. Instead, they paid off debt, diversified their wealth, deferred all of their tax, and we sat on the sideline. And which was so cool, we invested the funds into Bitcoin, mostly lending fund for the first year and a half. And then we dollar cost averaged into deals that were getting foreclosed on. Hotel syndications, where were some of the foreclosures? Multifamily, we've dollar cost averaged, not as many foreclosures there. But that's the whole concept. Our parents taught us to sell high and buy low, right? They didn't teach us to sell high and buy higher 180 days later with their hair on fire trying to negotiate with the banks that our interest rates have jumped and now it's with negative arbitrage and no leverage and a lot of the rents that are flattening out. And I mean, all of these things, like it doesn't make any sense. Like if you think about the 1031, oftentimes it doesn't make any sense. So why would you let the tax tail wag the investment dog? Well, you no longer have to do that anymore. You can unlock truly passive income. But oh, by the way, you can still partner with the trust and go back and buy your own deal. And you can partner with the trust. And this is the piece that most people make the mistake. They think that, oh, well, then I'm just going to be passive and I'm just, entrusting all of this and I can't make money on my own anymore. No, you can partner with the trust post-close immediately, or you can wait a year or two or whenever you want to go. And the trust can be a silent joint venture partner. And it can invest into an LLC, which you run and you're the managing member and you have the majority ownership. And you can develop and build multifamily properties or a new business venture. We did a Bitcoin exit to bring this to life. She had bought Bitcoin, very, very, very low amount, low price point. She put up $50,000, like almost her whole life, a lot of her life savings. Well, that $50,000 turned into $50 million. Okay. And she never exited Bitcoin until she met us. And she exited 5 million and put it into the Deferred Sales Trust. And we deferred about 2 million of tax, 1.85. She lived in San Jose. She worked for Google. Okay. And so, but the key is not only could she defer the tax, but she turned around and for the 5 million went into a new business venture like a Khan Academy to make an impact to educate kids with a college roommate. That was her dream. Right. So the question is like, what is your dream? What is your passion? Like, what are you trying to do? And is it holding you back that you have this asset that you'd love to harvest the gains, but you got this massive capital gains taxes? So again, I go back to this concept that you want to really focus on, that truly passive income is to your freedom and impact, as compounding interest is to your money. And so if the mistake that people make is they just think about cash flow. They don't think about tax flow, right? They don't think about debt flow, and they don't think about it in the 3D realm, because a lot of the tools they're using are putting them in boxes like the 1031. But once you open up, the idea of how to solve these problems, it can bring all of these together, and then you can unlock these types of really a wealth building machine like you've never seen before.
Very cool. Why do people not do this more? Is it just because there's education? Is there an education gap? Is it for some people too complicated? Like, why would one not want to do this? I think particularly when you've got probably north of the $5 million number is when this probably starts to make a lot more sense, if I'm just guessing. But I'd be curious to know the answer.
Let me start with who qualifies. You need to have $1 million net proceeds and $1 million gain to qualify. Okay. Now, it doesn't mean you can't do it for smaller. It doesn't necessarily make sense. We found for the complexity and for everything else. So if you have $1 million net proceeds, $1 million gain, you can use the Deferred Sales Trust. It's a great fit for you, unless you need to spend it all on your personal, something personal right away. One exception, if you have two deals at $500,000 each, we can combine those two into one, one trust, multiple promissory notes. Okay, so there's really three things that hold people back from doing the Deferred Sales Trust, right? The first one is the mistake that your CPA should and could, and why does he know about it, right? And the mistake is that this CPA is my family practitioner. He's been taking my blood. He's been giving me my flu shot. He's been giving me my checkup. I feel emotionally really connected to this guy or gal because they've really been there for me for my taxes, and they do my tax return, my business tax return, and I see him every year. And I hear about this Deferred Sales Trust on the podcast with Craig and Brett and the YouTube channel, and I go to my family practitioner and they say, "Oh, well, I've never heard of it. So I don't know. It seems risky to me." So that's one of the biggest mistakes that people make. Now, here's the myth buster for this one. Guess who represents you? A CPA and a tax attorney. A CPA and a tax attorney. So don't make the mistake of having your CPA be let's say I was going to get ACL surgery. I played basketball in college. I mentioned that in the beginning, right? I blew out my ACL 2 weeks after I signed my scholarship, right? It's like I'm at the high moment. I'm like, awesome. I'm dunking the basketball. I'm a 6-foot white guy. I could dunk at this point. I'm like, yeah, best shape of my life. I signed this scholarship. My dreams are coming true. Da 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 da. Boom, blow my ACL out, okay? And I'm like, oh no. I go to my family practitioner. He gives me the little ACL check. Have you ever seen the people when they grab the knee and they kind of do the check? Oh, you're fine. You don't need a surgery. I'm like, oh, thanks, doc. I don't need a surgery. I go, are you sure? He's like, no, you don't need one. Should I get an MRI? He's like, no, you're wasting your time. You're good. Okay. So I just get PT for 3 weeks and you'll be back. You're good to go. I'm all right. My brother, the smart older brother, says, Brett, go get another opinion with an MRI just to be certain, because if you go back and you don't know for sure whether or not you have an ACL, you can ruin your knee for the rest of your life. I'm like, okay, brother, but I really trust my family practitioner. He's like, no, just do it. I go back to the family practitioner. Okay, hey, I really want an MRI. You don't need an MRI. You're wasting your time. I'm like, please. I plead with him. He goes, fine. He's writing it up. He's shaking his head. He's writing up the referral. And he's like, you're wasting your time. You're going to drive all over there. Blah, 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 blah. I'm like, okay, but I just want to be safe. Better safe than sorry. He's like, okay. Blah, blah, blah. Okay, so 2 weeks later, we get the results back. Guess what happened, Craig?
Ripped everything up.
He calls me up. Hey, Brett. I'm like, hey, doctor, what's going on? I got your results back. All right, how do they turn out? Your ACL is completely ruptured. You need reconstructive surgery. And guess what he did? This is what he didn't say. Brett, I'm so sorry that I even put you potentially at risk. And I was so enthusiastically against you getting this MRI, and I almost put your entire, your life of your knee at risk. No, he didn't say any of that. So too often the CPA is kind of the guy who's like, I don't want to take the risk, right? And now this doesn't really quite fit the what I'm saying here. What the CPA should go and say, let me go check it out. Let's talk with the CPAs. Let's do the investigation. More than that, I think the client's mistake is they need to put their CPA and bring them to the calls, right? And this is the reality. Once they show up, 99% of them, they all join us. They all send us referrals once they understand what it is. So yeah, lack of education or emotionally counting on your CPA so much to think that they're going to have every single part of the knowledge, and they don't. They basically report what happened versus strategically show this. So now
you're giving them more work as well. So we're talking about basically people not understanding it fully, or basically CPAs just not really checking for you, or maybe you not asking the right questions, kind of.
Yeah, I think for the people who have not done the deferred sales trust, we have a very high close ratio. The number one mistake they make is they put too much and too little of time in the CPA's hands versus, pre-planning, bringing the CPA in and making it a collaborative effort and to look at the evidence. The second one is that real estate agents and the 1031 exchange companies, most of them, they don't want you to know about this. They make their money in the 1031 exchange. They make their money when transactions happen. They make their money by having the capital flow in and out of real estate. That's 100% how they make their money. If it gets out of real estate, or then they don't make money, right? And so that's the reality that the Deferred Sales Trust is essentially exiting a lot of times out of the traditional, Sacramento, Bay Area, New York, or wherever that little circle of capital just keeps flowing around. And now it exits, and now that agent goes, I've just built 1, 3, 5, 10 years of a relationship, and now all of the money is just gone,
Yeah.
and I have no chance. And they're like, yeah, why would I want to own in New York, New Jersey, or California anymore? Why would I be forced to deal with a lot of this? And so that's kind of the big challenge. I would say the next one would be, trustee, right? So I'm a third party unrelated trustee. So you got to be able to say, all right, they have to give up some control, right? They don't have unilateral control, but just like if they invest with Lone Star, they have to get comfortable with who Lone Star and Craig and Rob and the team, right? So, but the reality is we have multiple people. Like we have the tax attorney, we have myself, we work with, financial advisors. We work with groups like Lone Star to place capital places. So it's really building a team. So once people understand, like, oh, it's not just one person, it's a team effort. I can diversify and get multiple professionals. It's actually an enhancement to the wealth plan. That's where they go, oh, I get it. Okay, that makes sense. But they don't own the trust. They don't have unilateral control. They have to, take back a promissory note, but they are the sole creditor, right? And we map out let's say it's a $10 million exit and they would have paid $4 million of tax. We structure the note, let's say at like 8 or 9% interest rate. So it's 10 million paying about 8 or 9, but they may only take, 4 or 500,000 year one and let the other amount accrue. But we're going to build out a wealth plan that they're comfortable with based upon the risk tolerance, and that they'll slowly pay tax over time. So I think it's knowledge, it's trustee, it's CPA. And the last one would just be fees, like how to make the DST an investment and not an expense. The fees are about 1.5% on the first million and then 1.25 on anything above to set it up on the gross sales price. And then about 1.5% to 2% on an annual recurring basis based upon the net proceeds to the trust. And so you got to understand how to make it an investment, not an expense, because at first blush, you might think that sounds expensive. Although I would say if you're selling real estate, you're paying anywhere between 4 to 6% in commission one time. And then if someone's managing capital, depending on where they're managing it, they're not uncommon to be 1 to 2%. But we can typically make, Craig, 8, 9, 10% compounding net of our fees on average per year over any 10-year period of time. And so when people do the math, they go, oh, I would have 6 million versus 10 million working for me. Okay, that makes sense. That makes sense for me. Oh, I can defer my income tax too. Like let's say I live in California, New York, New Jersey, or really any state. I don't have to take the full $900,000 of payment. I can take 200,000 or 300,000 and let the other amount accrue and be deferred. Wow. And so that's what we walk people through. And so once they, the legal, the trustee, the fees, then I call the big domino falls, and 99% of them say yes to this. But hopefully that answers your question on that, Craig.
Yeah, well, I think it's interesting on a risk perspective, right? Let's say if you're, someone in the Bay Area, it's not uncommon that you might have, call it a $10 million net worth, but 6 of which is actually all in your primary residence, which is not really making anything for you. So your lifestyle, although you've got $10 million bankrolled, you're very successful. You're the 1% of 1%, really, probably, but your lifestyle is not really of that. And I would argue it's actually riskier to have, that much of a disproportionate amount of your net worth tied up in one thing that, I'm not saying it's a liability. A lot of people own their houses free and clear. It's where you live. You got to live somewhere. But that much consolidation and concentration of wealth in one asset, not kind of producing any yield for you, could also be risky as well. So it's just something to think about. It's a different mindset. It's a different way to feel comfortable with things like that. And yeah, anything you do, if you're saving a lot of money, if you're doing something well, like we do at Lone Star, or you do with your company there, yeah, there's fees associated, but everything there's fees associated. I think some people are afraid to let another professional do something. It's kind of relinquishing control. I think a lot of successful people, they got there on their own hard work, usually speaking. And, if they're not controlling it, they don't feel comfortable.
100%. And so that's why I want to, again, encourage everybody that, truly passive income is something to value, because it opens up so many things like impact, it opens up freedom, and it opens up the opportunity to diversify, right? And not have to have all of your eggs over concentrated in a single asset class or at a single time, right? And so when so the Deferred Sales Trust unlocks that, right? It unlocks passive income, and also unlocks, we typically are at 10 to 15% returns on an average over any 10-year period of time. No debt, no liability, no tenants, no hassles, no lost time. Again, it's like Kenny Chesney: no shoes, no shirt, no problem. You can basically be completely passive, increase your ROE. We have another deal that we helped a client out of California. It was a sale of a multifamily property in Sacramento, a $2.5 million sale. I'm actually a California real estate broker too, so I actually represented them on that sale. And, their net proceeds was about 2.35. Their NOI was about 120,000, current, before selling. Now they had 2 daughters that are twin daughters at 10 years old. And so I asked them, why use the Deferred Sales Trust? And they said, well, it's really simple, Brett. We're trading the 3 T's of the toilets, trash, and termites for our 2 T's, our 2 twin daughters, and really spending time with them before they're 18, instead of Warren having to drive, 3-4 hours in traffic back and forth. and then, lose him for the weekend, he can spend more time with us. He's now retired from his day-to-day job, but he also had the side, time and energy with the multifamily property. Even though it was a nice property in a nice location with great tenants, it just, took up a lot of time. In fact, Warren and Catherine are their name. Catherine was in the military, and she's a mom, and she's also really strategic. She also does like independent work for like security stuff. And then he worked at the hospital for many, many years. He was a nurse. And so now you're seeing this change of their time and their energy and their value for where they're going to spend it. But yet you have this capital gains tax. And so was their solution to sell 15 units and buy 30? No. Their solution was to completely get out of real estate. Now, real estate in the sense of active ownership, but guess what we invested into? Passive multifamily investing. Passive multifamily properties, actually one in Texas, another passive multifamily deal in New Jersey that was a value add deal that was an amazing deal, discounted deal. And some stocks, some stocks and stuff. So we diversified, but they shared their story, and basically Warren really captured it for me. And he said, Brett, I didn't realize how much time and energy it was taking from me. He goes, until I was on the other side of it. And he goes, oh my gosh, it's so nice now. I'd never go back. Sometimes we don't know the freedom and impact that it can unlock once you're done with the toilets, trash liability, and the active ownership.
Yeah, and also I think a lot of people have to realize that there's professionals like us, groups like us. Now, obviously not all of them are created equally. There's a group like us that do it day in and day out, know the debt market, the equity market. We know the micro markets that we're in, and we're probably going to do a better job by and large than what you're going to do in your investment. Yeah, there's fees associated, but no one does anything for free, but you're paying us for professionalism, and we buy your time back. You're buying your time back by working with us. So I'm super happy that you touched on that. I'd be curious to know if you could just break down who the perfect client is. We call it in our business, we know it as the avatar. I think our investors who listen to the show may not understand that phrase, but Brett, on your end, who is your dream and ideal client?
Yeah, before I touch on that, I just want to finish my thought. 190,000 is their basically their NOI, if you will, on the trust net of fees. Amazing. Versus 120,000. So you think about that. We increased it by 70,000 per year, and we completely cleared their schedule. So not only did we buy back their time, we've compounded their return, right? And let me also throw another compounding part of this. They've delayed the income for at least a year, meaning they're in California. They're not paying any income tax on the year they haven't received any income. So it's kind of like an IRA, right? What do? You put the money into an IRA, and then it grows capital gains tax deferred and income tax deferred. Okay. So before, when they have really no basis remaining on 120,000, they're paying the full tax on that. Now, not only their 120 goes to 190, but they're able to keep that 190 turned off. So they're deferring all of the income tax on the 190, as well as the capital gains tax that they would have paid. They would have paid about $1 million of capital gains tax. Okay. So this is the type of like transformational impact you can have for you, whoever's listening to this, and someone you know. Okay. So who's our ideal client? So we call it the purpose-driven entrepreneur and investor. The purpose-driven entrepreneur and investor. And what we mean by that is you're probably net worth of $3 to $50 million. You probably built a business or a real estate through investment or hands-on investing. And you've had massive gains. You're between the ages of 45 and 75. And you're very intentional with your family and your legacy and your impact. You don't want to have to squander away your time and your energy to continue to own the real estate, or let the government squander the gains through taxation that just goes to almost nowhere. And you want to unlock your more freedom and time. You also want to get more momentum with your return on equity, right? You look at your return on equity. Working with a seller right now out of California. He's got 5 exits, and he'll have about $2 million into the trust. And he's like, I'm not even in California anymore. My ROE is 2.9%. Brett, we can double and triple that with the trust, and I have no more toilets, trash, and liability, and rent control and all the things that are associated with California real estate. I'm like, yeah. He's like, when do I sign up? Where has this been? What we found is we unlock capital because we unlock truly passive income in a way that helps people to get freedom. So yeah, so ROE is really important to understand. The person who wants, or needs more cash flow, they're real estate or business rich or Bitcoin rich, but they're cash flow light. They want diversification, liquidity. We also help clients that are entrepreneurial. I don't want you to think that just passive. Like we have a client, he's done 5 exits with us. It's like a Lone Star Capital, actually. They own about 3,000 units. His name is David. His business partner is Jordan. And like one of the recent sales is a $44 million multifamily sale out of Nevada. And they use their GP interest into this across 5 exits. They each exited. And every time they exited, they took their GP interest and they put it into the trust, meaning that the rest of the investors don't have to do it, right? So that's really cool. Like we call it the seamless partnership separation. It's like someone may want to exit their partner, but their partner might want to just pay their tax. So one might want to defer the tax. And so we are able to do a seamless partnership separation. Each of them have their trust, and then they deferred their tax. Now, these guys are still partners, still doing deals, but what I mean by that is all of the other LP partners, right? And so, but the cool thing is they can use the capital to invest into their next deals. So you can have your cake and eat it too. You can be an entrepreneur. You can be retired. You can be diversified. It's very flexible. And in fact, Warren and Catherine, their vision is once their kids are, 18 and maybe in college or something, that they're probably going to be more active again. Right? That's the cool part. In the meantime, they're going to be passive. It's up to them. So that's kind of probably the perfect client and those scenarios. If that makes sense, Craig.
It does. Now let's get to the next thing, which is finish financial freedom. You kind of mentioned that before. I know we wanted to get into it. So I'm actually not fully privy to this. I have an idea of it, but I'd love for you to kind of break it down.
Yeah, again, so back to financial freedom, we've been taught that and by the way, I play the game. I love Robert Kiyosaki, and I play the Rich Dad Poor Rat Race game with my daughters right now. And we sit around the table and we figure out how to get out of the rat race, and love it. Love the book, love everything about it. But it stops because I've been in these, California especially, where they're not they're financially free, but their time. I think a better way to think about it is wealth freedom, right? And wealth is more than just financial. It's time, it's relationships, it's spiritual, it's impact, it's fulfillment, it's fun, it's location freedom, right? So I think finished financial freedom unlocks wealth freedom. Finished financial freedom unlocks wealth freedom, and wealth freedom is all aspects of that. And so if you've made your multiple millions and yet you haven't been able to harvest it, you need to unlock finished financial freedom, which basically states that I don't have to do anything else, time, energy, effort, stress. And I know that X amount is going to be coming in per month, and it's going to be growing, right? And it's going to be we're going to be diversified. I'm going to have asset protection. Part of the cool thing about the Deferred Sales Trust is, if someone sues you, they can't sue what you don't own. The trust owes you money. They could get part of the interest on that pays to you, right? But they can't get the principal because it's outside of, it's asset protected. Really important. Now you're the sole creditor. This trust is not commingled with other trust or other money. Nothing means just your approval or your signature, all this stuff. But that's some asset protection that gives you some peace of mind. So that's my thought, and my thought on this is that if you can unlock truly passive income with finished financial freedom, you basically unlock the ability to think about things so much more multi-generationally, so much more with impact, like, freeing up time, like you mentioned before, to be able to do good things. And part of what we're doing, we'll be going to Uganda in March to do some clean water wells for some of the most vulnerable people who don't have clean water, that it'll save lives. And we'll be installing these wells with the entire family. Part of why I could do that is because I've achieved enough financial freedom that's finished to know that the income is going to come in regardless if I'm having to spend time on a podcast or one-on-one with the client, right? And so that's what I want to show people. Like, people just don't get that. They do the first step, but a lot of times they get stuck. But we want to finish that financial freedom by truly, truly unlocking all of your time and your energy.
I love it. I love it. Do you have anything else you want to mention before we wrap up the show? I think there was a couple things maybe we might have not gotten to. We could probably talk here for hours on end, like longer than a Joe Rogan episode here. But we're going to come close on time. Any last kind of theme or item that we did not mention yet that you'd like to share?
Yeah. Yeah, it's called the best 1031 exit plan, and that's the method. But the mistake most people make is they go into a regular 1031 thinking that they have a backup plan or they can do something else, but they don't. And so we provide a deferred sales trust as a backup plan to a 1031 exchange. And so it's called the best 1031 exit plan. And so I would encourage you to listen to, if you're listening to this for yourself or if you're a real estate agent or a financial advisor, to never go into a 1031 exchange without the best 1031 exit plan, which allows a regular 1031 exchange and a deferred sales trust with our company. And this unlocks so much leverage as a buyer to negotiate with the seller that otherwise would not give you the time of day for a retrade, is what they call it, right? Or concession or a price reduction, because they go, oh, he's in a 1031 exchange. I got him right where I want him. I'm not going to really give you anything for that. But instead you could say, no, I'm in a best 1031 exchange. That means I don't have to buy your property and I can still defer my tax. And when you just have the knowledge and you have the expertise behind you, you have all of the leverage. Okay. And so I would encourage everyone to not make the mistake of going into a regular 1031. Use the best 1031 exit plan and have a mindset that gives you leverage over sellers that you're negotiating with.
Makes sense. Can we also plug your book, please, and your podcast and all things like that?
Yeah. So the book is called Building a Capital Gains Tax Exit Plan. We have Kevin Harrington from Shark Tank. We have Neil Bawa. We have Mr. Don Winter. We have another other really, really smart people. And basically, it's my story from zero to where we're at today, from Cheesecake Factory, from Marcus and Millichap, to helping clients really have transformation with their exit plans. You can go to capitalgainstaxsolutions.com or just go to Amazon to pick up a copy, Building a Capital Gains Tax Exit Plan. That's the book, and the website's Capital Gains Tax Solutions. If you want to follow me on social media and all that stuff, go to brettswarts.com. That's Swarts with an S, Swarts, Brett with 2 T's, and you can follow me on LinkedIn, Facebook, Instagram. You can follow our story of our family to Uganda and what we'll be doing there, and that's basically it.
Are you taking on new clients right now?
Oh, of course. Yeah. We're constantly growing. We had one of our biggest year last year. This year, we anticipate, especially with Bitcoin, a lot of exits to have even compound those exits. But yeah, business, real estate, Bitcoin, any asset of any kind, we can help you.
Brett, you've been such a pleasure to speak with today. I hope to have you on the podcast again. Seriously, you're a wealth of knowledge. Thank you so much for your time. For listeners who are here today, please reach out to this guy or even send this episode to someone who you think it might be a fit for. You might be not as wealthy as one of his clients right now, but you probably know someone that might be there. Or if you're that person who's wealthy enough, send this to your friend. Use him. Please leverage these tools we have on this channel for you. This is all about you. Brett, thank you so much for coming on. We appreciate it. For all the listeners, we'll see you next week. Peace.
Bye, everybody.